Is this the most screaming, obvious, strong buy in the entire market right now? Or is it just a terrifying value trap waiting to spring on unsuspecting retail traders?
That is the big question right now. I mean, the momentum is just, it's wild.
Yeah, it really is. So welcome to this deep dive. Today we're looking at the data you requested on the Direxion Daily Semiconductor Bull 3X shares. Most people just know it by its ticker, SOXL.
Right, SOXL. And we are looking at the data as of today, April 15th, 2026.
Yeah, and it is currently trading at $87.05. It is riding this unbelievable 10-day consecutive winning streak.
It's historic momentum. But before we even jump into the numbers, we just need to say up front that this is an educational deep dive.
Yeah.
We are just analyzing the market data, but this is absolutely not financial advice.
Exactly, not financial advice. Oh, and real quick, if you are finding this useful, please hit the like button, subscribe to the YouTube channel. It's actually compulsory that you leave a comment down below so we can keep this debate going.
Yeah, we want to hear what you think about this one because the numbers are polarizing.
Okay, so let's unpack this. A 10-day winning streak is crazy, but the year-to-date performance is, well, it's a staggering 104.52% gain.
Plus 104% in just a few months.
Right. And if you zoom out to the 52-week low, this thing was sitting at $8.15. Now it's practically brushing up against 90 bucks. I mean, when an asset skyrockets that hard, you really have to look closer.
You do, because before we try to predict where this ETF is going, you really need to understand the massive scale of what it is right now. I mean, who is actually moving the money here?
Right. The financials are just giant.
They are. The assets under management, the AUM, is sitting at $13.54 billion.
Wow. 13.5 billion. And the daily volume is about 86.7 million shares. That is a ton of liquidity.
It's massive daily movement, but holding this fund is not cheap. The expense ratio is 0.75% net.
Which is pretty high. I mean, gross is what, 0.91%? It's like buying a high-performance sports car. You can't just look at the sticker price. You have to factor in the massive daily maintenance costs.
That's a really good analogy. That 0.75% is basically paying for a pit crew to aggressively manage the leverage every single day.
Yeah.
But what's fascinating here is the institutional involvement. You look at the big players, Jane Street Group, Susquehanna International, Citadel Advisors, they are massive holders.
Oh, absolutely.
And their institutional share value has jumped 646.73% over the last year.
Wait, okay, hold on. Because there is a huge glaring contradiction in the data here. The headline price is up 104% this year, right?
Right.
But the fund is actually seeing notable year-to-date outflows. I mean, it is in the bottom 10% of its peers for outflows.
Yep. It's bleeding cash on a net basis.
So the smart money is actually leaving.
Exactly. And this is why you need to care about this. Even as the price just surges on this 10-day streak, the institutions might be quietly taking profits. They're hedging their bets and, locking in those insane 646% gains.
Well, retail guys are probably just piling in because they see green candles.
Pretty much. They see the streak and they jump.
Okay, so if the big players are quietly taking chips off the table, why does the price keep going up? Let's look at the technicals.
Well, the technicals are basically just screaming momentum. The trend is strongly bullish. It's up roughly 79% in just the last fortnight.
79% in 2 weeks. That's insane. And the moving averages?
They're all flashing by, universally. The 5-day is at 83.06. The 50-day is way down at 72.99.
And the 200-day is all the way down at 57.32. I mean, we are trading 30 bucks above the 200-day moving average.
Yeah, the detachment from the long-term trend is aggressive. Plus, the MACD is sitting at 3.25. It actually triggered a solid buy signal back on April 2nd.
Okay, but what about the battlefield? Where are the lines drawn right now?
Well, if we look at support, we have floors at 82.16, then down to 79 even, and 77.30.
So that's where buyers would theoretically step back in if it dips.
Right. But overhead resistance is looming fast. We're looking at 88.72, then 91.88, and a big one at 95.19.
So there's a ceiling approaching, but sentiment is still heavily bullish, right?
Extremely. It's 70% bullish. And if you look at the options data, 62.3% of the dollar volume is sitting in calls. People are betting real money on the upside.
And I noticed in the data, there's incredibly high buying pressure right near the session closes.
Yeah.
Like around 85.50.
Yeah. The end-of-day buying is a huge tell. It suggests traders are literally betting on gap-up continuations. They don't want to be out of the market overnight.
But, okay, I got to push back on this. Because if you look at the relative strength index, the RSI.
Uh-oh, yeah, the RSI.
It's at 70.68. So for you listening, an RSI over 70 means conditions are officially mathematically overbought.
Very overbought.
So what does this all mean? If the RSI is telling us the engine is overheating, but momentum is still flashing by, are we basically driving 120 miles per hour while just ignoring the check engine light?
That is the exact tension of a momentum trade. It's an overheated engine for sure, but, a stock can stay overbought longer than you can stay solvent trying to short it. But this brings us to the real debate. Are buyers jumping into an undervalued, structural tech boom, or are they stepping into an ultimate value trap?
Let's talk about that, because if you just casually check the PE ratio, the price to earnings, it's sitting around 21.05.
Which looks totally fine.
Right. For high-growth tech, 21 is nothing. To a retail trader, that screams undervalued play.
It does, but it is incredibly deceiving. I mean, analysts warn that the PE has actually spiked to 64x during specific periods recently.
Wow, 64 is a whole different ballgame.
Exactly. And more importantly, and this is what trips people up, this is a 3x leverage ETF. There are no traditional corporate insiders here.
Right, because it's not a company.
No, it's a derivative. You can't rely on standard fundamental analysis because you aren't buying a semiconductor business. You're buying a financial product that mathematically tracks an index.
Yeah, this raises a really important question about how retail traders see this. They see the 104% YTD gain, they see a reasonable-looking PE, and they just hit buy.
Blind FOMO.
Exactly, fear of missing out. But they don't realize the actual math of daily leverage, especially with the threat of stuff like interest rate hikes looming over tech.
And that math is brutal. Because to get that 3x leverage, the fund managers have to use total return swaps.
Let's quickly explain total return swaps for anyone who isn't familiar.
Sure. Basically, the ETF goes to a big bank and says, hey, we will pay you a financing fee, and in exchange, you pay us 3 times the daily return of the semiconductor index.
Sounds great when the index goes up.
Right. But the catch is that this resets every single day. The fund managers literally have to buy more of these contracts when the market is up right at the end of the day.
Buying high.
Yes. And if the market drops, they have to sell off exposure at the bottom to maintain the ratio for the next day.
So they're systematically forced to buy high and sell low. That is wild.
It is, and that constant daily rebalancing is the hidden friction.
Okay, so having established that this thing could be a massive trap, let's look at the best and worst case scenarios. The bull case versus the bear case.
Let's start with the bulls. The upside catalysts are huge.
They really are. I mean, the best case recovery and continuation scenario is all about structural, unending AI chip demand.
AI is driving the entire bus right now.
Exactly. Plus, you have the potential easing of U.S. chip export controls, which would open up huge markets again. And everyone is highly anticipating positive earnings from TSMC.
If all of that hits, the momentum just keeps running. But the bear case, the downside risks are terrifying.
What's the biggest threat? Is it just supply chain inventory adjustments?
No, it's not just inventory or even rate hikes. The biggest danger is the fact that semiconductors are historically a cyclical industry.
Boom and bust.
Exactly. And if we hit a cyclical peak, if demand just normalizes slightly, projections show a potential 90% correction by late 2026.
90%. That is a total wipeout.
Complete devastation for anyone holding it. And here's the craziest part. You don't even need the underlying semiconductor sector to crash 90% for the ETF to lose 90%.
Wait, really? How does that work?
It's because of volatility decay. Since the 3x leverage resets daily, the ETF can mathematically bleed out even if the underlying index eventually just trades flat.
Oh, this is where it gets really interesting. I always think of it like trying to climb a muddy hill.
I love that analogy.
Now, you take 2 steps forward and you slide 2 steps back.
Yeah.
But because of how the leverage resets, every time you step back, your legs actually shrink by a few inches.
Yes.
So the next time you step forward, you can't go as far.
Exactly. Let's actually put some quick numbers to that muddy hill so you can see the leg shrinking in action.
Let's do it.
Say the semiconductor index is at 100, and your 3x ETF is also at 100.
Okay, starting even.
Day 1, the market gets spooked. The index drops 10% down to 90.
So the 3x ETF drops 30%. It goes from 100 down to 70.
Right. Now, day 2, the market completely recovers. The index goes from 90 back up to 100.
So that's an 11.1% gain for the underlying index.
Correct, which means the 3x ETF has to gain 3 times that. So it gains 33.3%.
Okay, so 33.3% on the new balance of 70.
Is about 23 points, so the ETF goes from 70 up to 93.
Wow. Let me just pause and highlight that for you listening. Over 2 days, the market index went down to 90 and right back up to 100. It is perfectly flat.
Zero change in the actual market.
But your 3x ETF went from 100 down to 70 and only recovered to 93. You lost 7% of your money while the market literally did nothing.
That is volatility decay. In a whipsawing, choppy market, your account just bleeds to death.
That is brutal. So with these massive opposing forces, the insane AI momentum pushing it up,
Yeah.
and the mathematical volatility decay dragging it down, what are the actual timeline forecasts?
Well, looking at the short-term forecast, so the coming days and weeks, the target range is actually $92 to $102 by May 2026.
Pushing past 100.
Yeah, the momentum makes it possible. However, statistically, a minor pullback is highly, highly likely first. You don't get a 10-day streak without the engine needing a breather.
That makes sense. What about the medium term?
By mid-2026, there is a 90% probability the ETF will consolidate and bounce between 39.06 and 83.59.
Wait, the top end of that medium-term range is 83.59? That's lower than today's price.
Yep. It implies that right now we are severely overextended.
Okay, but I got to bring up the long-term forecast, because this is what retail traders on Reddit are constantly talking about.
Oh, the 2031 target?
Yes, the wild speculative long-term target of $945 by 2031. It just assumes AI demand is purely structural forever.
Right, but if we connect this to the bigger picture and everything we just talked about with the muddy hill aiming for that 2031 target is incredibly reckless.
Because of the decay.
Yes, the volatility decay over 5 years would obliterate your capital. These are short-term trading tools. They are not buy and hold for retirement assets.
You cannot just park your money in a 3x daily ETF and go to sleep.
No, that is financial suicide.
So, just to wrap up this deep dive and summarize these intense cross-currents, we have universally bullish technicals right now, right?
Very bullish.
Massive 10-day momentum, real AI demand. But underneath all that, we have alarming institutional outflows.
The smart money is leaving.
Exactly. And you have the ever-present, terrifying danger of a leveraged reset trap.
It is a perfect storm of risk and reward.
Which really leaves us with a final, I think, quite provocative thought to chew on.
What's that?
Well, if retail traders are blindly piling into this heavily leveraged instrument based purely on FOMO, while the biggest institutional players are quietly siphoning off their profits, who is actually going to be left holding the bag when the market finally whipsaws?
The retail guys.
Right. But take it a step further. What if this current AI boom isn't a permanent structural shift, but just another cycle waiting to peak? If hundreds of thousands of retail traders get margin called and forced into liquidation on heavily leveraged derivatives like SOXL,
Oh, wow.
could the sheer volume of that forced unwinding trigger a contagion effect?
Yeah.
Could these mathematical bets actually drag down the real, non-leveraged tech sector with them?
That is the nightmare scenario. If the tail starts wagging the dog, that systemic risk could bleed into everything.
It's definitely something to think about. Remember, you have to do your own due diligence. This has been an educational debate, not financial advice.
Stay safe out there.
Thanks for joining us. Don't forget to like, subscribe, and leave your thoughts in the comments. We'll see you next time.